From your perspective, how does this demonstrate to us just how wide-reaching his tariff policies are when you think about these tariffs in particular being enacted under Section 232 on the basis of national security concerns?
The bigger picture is one of governance problems, both domestically and internationally, that the president has declared emergencies, and the emergencies don't necessarily tie to what the law says. I mean, there's no way that steel flatware is a national security issue.
Provinces issued massive foreign bonds, shutting out U.S. banks entirely. Ontario's $2 billion deal handled by Barclays and Canadian banks marked the first bond of its kind without Wall Street's involvement since 2011. The move came as U.S. tariffs placed heavy pressure on Canada's steel and auto industries, and the message was unmistakable. Find strength elsewhere. What unfolds here could signal a turning point in North America's financial future. Tariffs have done more than strain trade ties. They've begun to jolt the financial circuitry that binds North America together. In June 2025, Ontario issued a $2 billion Yankee bond. And for the first time since 2011, not a single U.S. bank was involved. Instead, the province turned to Barclays alongside Canadian giants like CIBC and Scotiabank. This was not a matter of chasing lower rates. It was a strategic maneuver shaped by months of escalating tariff battles. Washington's duties on steel, technology, and automotive parts had already squeezed Ontario's backbone industries. Now, the province decided to hit back at the very heart of American influence, its financial system. Ontario's economy is intertwined with auto production, home to major plants for Ford, GM, and Honda. Every financing decision in this sector carries weight across the supply chain. By pushing Wall Street aside, the Ford administration was sending a message that it would no longer play on Washington's terms. With borrowing needs projected to reach $60 billion this year and nearly a third expected to come from foreign markets, this pivot was more than symbolic. Billions in capital would now flow through London and Frankfurt rather than New York. The province was setting a precedent, signaling that the path forward would be shaped not only by trade policy, but by the direction of global capital. That turn became even clearer when Alberta followed suit. Months before Ontario's decision, Alberta had floated one. €25 billion in bonds handled by Barclays, RBC and TD. It was the province's first issue without Bank of America in 6 years. Officials insisted U.S. banks weren't excluded, but the shift spoke volumes. Alberta's choice marked a broader reorientation, one that stretched far beyond finance. At the same time, the province began rerouting oil exports, reviving tanker traffic toward Asia and the Gulf of Mexico. The financiers underwriting these ventures were no longer American institutions, but European insurers, bankers, and even pension funds. Frankfurt's boardrooms were becoming as central to Alberta's planning as Washington's ever were. The consequences rippled through Alberta's economy. Trucking and logistics operators, especially those tied to the energy sector, suddenly found their financing. Discussions drifting away from Manhattan and toward Mayfair. For an Edmonton hauler seeking a new line of credit, the likely partners were no longer American lenders, but European firms eager to step into the vacuum. What began with bond sales was reshaping entire industries, shifting not only where capital was raised, but who set the rules of engagement for the province's economic future. The shift was not confined to debt markets and exports. Canada's procurement policies began to evolve in lockstep. Ontario introduced new rules that prioritized Canadian and allied vendors in government contracts, leaving U.S. firms at a disadvantage. For software companies in Seattle or steel supplies in Pittsburgh, opportunities that once seemed secure were slipping away unless no viable local alternative existed. Their bids were increasingly ignored. The ripple effects spread quickly. In one notable case, a hospital turned to a Swedish software provider instead of an American competitor, citing currency stability and cost efficiency. That decision reflected more than a preference. It highlighted a pattern taking hold across the public sector. From municipal broadband systems to infrastructure projects, the bias toward non-US suppliers became clear. Multiply those choices across thousands of contracts, and the shift carried weight that reached deep into the North American economy. For automakers, the recalibration was even sharper. With Canadian suppliers climbing higher on the priority list and US inputs pushed down, factories in Ontario had to rethink procurement at a time when supply chains were already under strain. Even provinces like British Columbia, which maintained partial alignment with US financial institutions, could not stem the broader momentum. The gears of North America's financial machinery were grinding, and Canada was maneuvering into a different lane. What began as a fight over tariffs was steadily redrawing the map of financial partnerships and trade alliances. Yet, behind these visible changes, something even deeper was stirring within Canada's financial system. Quiet cracks began to show in the armor of the US dollar's dominance as Ontario and Alberta increasingly bypassed American banks. Subtle strains emerged in dollar liquidity across Canadian markets. Late-night commodity traders in Vancouver began reporting delays in accessing US dollars. A faint but troubling echo of the liquidity issues last seen during the Asian financial crisis of 1998. It was not yet a crisis, but the warning signs were flashing. Canadian institutions took note. Risk models that once leaned heavily on the Federal Reserve's framework were recalibrated against the European Central Bank's yield curves. What might seem like a technical adjustment reflected a much larger shift. Capital strategy was now being shaped by European signals rather than American ones. Even as cross-border flows remained strong, over $1 trillion of Canadian assets parked in the United States and $500 billion moving in the opposite direction, the hedges were quietly being built. One Boston-based fund recently added protective positions against potential disruptions in U.S. Canada trade without shifting assets outright. The aim was clear. Remain exposed to opportunity, but prepare for turbulence. Those hedges mirrored the cautious adjustments happening across Canadian markets. The sense was not of panic, but of a system preparing for instability. On the ground, the effects became tangible. In Thunder Bay, a solar panel startup saw its market share surge after tariffs targeted Chinese imports only to stumble when copper shipments from Shanghai were delayed. The boom and bust within months underscored the volatility of a globalized supply chain where even local successes could be undone by bottlenecks oceans away. The auto industry in Ontario provided perhaps the most vivid example of these shifts colliding. Factories that once relied seamlessly on American financial networks now had to navigate a patchwork of new rules, procurement policies, and capital flows. Every financing decision carried implications for where cars would be built, which suppliers would thrive, and which markets would open or close. The choices made in Toronto or Edmonton were no longer technical matters of finance. They were steering the trajectory of North American manufacturing itself. And the decisions of today will determine whether North America's financial future continues to run through New York or whether new centers of power take the wheel. Moreover, at the eye of this financial cyclone sits Ontario's automotive heartland, the region where tariffs delivered their harshest blows and where Canada's financial counterstrike now lands with precision. Ford, GM, and Honda run massive facilities across the province, and every shift in bond pricing, foreign capital access, or procurement policy carries immediate consequences. These adjustments are not abstract calculations. They determine production schedules, labor targets, and plant expansions. When Ontario pivots its borrowing away from New York and toward Frankfurt, the result is a reordering of who sits at the investment table and who gets left behind. Yet, the gears of this transition do not always turn smoothly. European financiers, many guided by strict ESG mandates, often hesitate to fund carbon-heavy industries. That hesitation presents new headaches for energy-linked provinces such as Alberta and for vehicle programs that remain tied to internal combustion technologies. While Ontario fights its battles on the financial front, American agriculture faces a storm of its own. Tariffs began to erode the value of U.S. corn long before it ever left the docks. When the White House imposed steep fees on Chinese-built cargo ships, the aftershocks hit the American farm belt with brutal force. Shipping costs through the Gulf of Mexico surged by nearly a quarter, adding hundreds of millions in export expenses. Across the Pacific, container rates doubled within weeks, climbing to $5,000 per unit and turning an already fragile post-pandemic trade system into a choke point for farmers. Transportation costs were only the first blow. By March 2025, an even heavier burden arrived when the Federal Grain Inspection Service tightened pesticide residue standards. Testing fees jumped 40% and every shipment faced a new chemical threshold before it could move abroad. Loads that failed inspection mid-route risked rejection and expensive returns. Barge traffic on the Mississippi fell well below the 5-year average, leaving New Orleans to function as a floating warehouse. More than 180 vessels sat idle, waiting for scarce inspections and limited containers. As corn spoiled in the rain, farm revenues shrank by the hour. Each week of delay shaved an estimated 27 cents off every bushel. For growers in Iowa and Indiana, those losses accumulated faster than their balance sheets could sustain. International buyers, watching the bottlenecks mount, recalibrated their expectations. The global market no longer demanded only abundance. It demanded grain that was traceable, clean, and sustainable. The real shock came in February when Mexico, America's largest corn buyer, announced a ban on genetically modified imports. International feed mills and processors quickly followed, writing similar restrictions into contracts. With more than 90% of U.S. corn acreage genetically modified, the decision instantly sidelined America's supply. Global demand did not disappear. It shifted north of the border. Canada had been preparing for this moment for years. Its Prairie Trace blockchain system documented every step of production from seed to shipment. Canadian grain arrived with verification, low-carbon scoring, and a reputation for purity that matched the new global appetite. Within weeks, Canadian exporters locked in long-term supply contracts with Japan, South Korea, and the European Union. These agreements worth billions signaled a decisive realignment of trust in global grain trade. The consequences for the American Midwest were severe. Spot corn prices collapsed to $345 per bushel, the lowest in nearly a decade. At the same time, corn grown in Manitoba earned $4.20 per bushel, reflecting the premium on traceability and compliance with environmental standards. Buyers were willing to pay more for confidence, and they no longer waited for U.S. producers to catch up. Cancellations poured in as contracts with Midwest cooperatives were terminated. Barges remained anchored, silos overflowed, and buyers shifted north without hesitation. America's long-standing role as the anchor of global grain supply began to erode before farmers' eyes. Canada, by contrast, met every demand of the new market environment, and its shipments carried not only grain, but credibility. The dominoes continued to fall. U.S. corn stocks swelled to a 6-year high. By late September, the USDA projected 2.5 billion bushels, around 68 million tons, would remain unsold. In Cedar Rapids, full delivery corn traded at $3.74 per bushel, well below the cost of production. Iowa farmers faced average input costs of $165 per acre, a burden many could not recover. Some left their combines idle, knowing a harvest would only deepen the loss. Others sold equipment or turned to second jobs to cover their mortgages. The rural economy in Indiana faltered. In the first quarter of 2025, the state's economy contracted by more than 6%. Food banks faced overwhelming demand, and families who had once fed the world found themselves lining up for donations. The Food Bank of Indiana warned that more than 130 million meals for low-income households were at risk of disappearing as federal programs and surplus grain supplies dried up. Illinois confronted a different kind of breakdown. Low water levels on the Mississippi, now an almost annual crisis, forced shippers to lighten loads and shorten tows for a third straight year. Each ton of corn carried an added $20 cost, eroding already thin margins. Barges waited for weeks, further straining the chain. With storage maxed out and no profitable way to move crops, land investment firms began snapping up distressed farms at cut-rate prices. The stress reached schools and small towns as well. Rural districts adopted part-time online schedules to cut electricity expenses. In Nebraska and Minnesota, water restrictions killed irrigation, slicing into yields. Co-ops froze grain purchases, leaving highways empty of farm traffic. Local diners shut early as customers vanished. Newspapers described these communities as ghost economies, standing but hollowed of momentum. The ethanol industry, long a stabilizer for surplus corn, faltered under the combined weight of tariffs and supply chain breakdowns. Production across the Midwest dropped to under 88% of capacity. 25 plants idled, cutting more than 1 billion gallons of output. In Nebraska, Valero's facility in Columbus reduced operations to a skeleton shift, eliminating over 100 jobs. Every lost buyer shrank the market further, and every idle plant deepened the crisis. From the silos of Iowa to the rail yards of Illinois and the ethanol plants of Nebraska, the entire chain that once turned corn into economic strength now became a liability. The crop that defined America's agricultural power had transformed into a burden. Meanwhile, Canada pressed its advantage with discipline and precision. Every container leaving Canadian ports carried traceability, purity, and low-carbon certification. Buyers not only secured grain, they secured a narrative of transparency and sustainability to present to their own markets. That narrative carried a financial premium. Old crop basis prices in Ontario rose nearly $2 above Chicago futures. Even new crop sales commanded premiums of 18% or more. Asia and Europe sent a clear signal. Reliability and credibility were worth the price. Canada solidified this edge through diplomacy and logistics. In March 2025, Canada and South Korea signed an organic equivalency arrangement, removing additional inspection barriers for certified Canadian grain. Ontario cooperatives immediately secured 5-year supply contracts. Saskatchewan followed with long-term deals in Japan and the Netherlands, aided by the weak Canadian dollar and America's tariff disputes. Export Development Canada provided insurance for small shipments and subsidized low-emission transport routes. Rail lines from the prairies to Vancouver were restructured for efficiency, even carrying discounted U.S. grain when returning from Asia to maximize utilization. Meanwhile, U.S. Gulf ports entered steep decline. That same week, Canada finalized its